Assalamu alaikum. My name is Hamza Khan, and I am recently working on a project which is related to stock market analysis. The focus of our project on to analyze the stock prices using the data of Google Finance. First, we know what is Google Finance. So, Google Finance is simple and free services from Google that help us to look up स्टॉक मार्केट इंफॉर्मेशन एंड फाइनेंशियल न्यूज। यानी गूगल फाइनेंस हमारे साथ एक सिंपल और यूज़र फ्रेंडली प्लेटफॉर्म है जिसके ज़रिए हमें स्टॉक मार्केट के बारे में पता चलता है। यानी अगर हमें एप्पल के स्टॉक प्राइस के बारे में जानना हो तो हम गूगल फाइनेंस पर डायरेक्ट जाकर APPLE लिख देंगे तो उसके ज़रिए हमें एप्पल की स्टॉक प्राइस आसानी से पता लग जाएगा। तो ये हमारे पास एक रियल टाइम डेटा है जो आपको बताता है, जो आपको मार्केट की तेज़ी के बारे में बताता है। So why we choose Google Finance? As I tell you earlier that Google Finance is a simple and user-friendly platform जो हमें की financial information provide करता है। Secondly, you can quickly search for stock price without needing advanced tool. Also, it is a perfect and easy way to learn about stock market. और इसके ज़रिए आप दुनिया भर के बड़े मार्केटों से हज़ारों कंपनियों का स्टॉक डेटा भी आसानी से हासिल कर सकते हैं। For this project, I use a stock market dataset source from Kaggle. Kaggle is a popular platform for data science and machine learning projects. The dataset provided key financial matrices for analyzing stock trends and building predictions. In our dataset, we have the following column, which is date, open, close, high, low, volume, and adjusted close. In that, our targeted column is open column, which represent the stock prices at the start of the trading session. This is our data sheet which has 7 columns. The first column is date column. The date column records the specific day when the stock data was collected. It is critical for tracking stock performance over time. The second column is open column, which is our targeted column. The open column shows the stock price at the start of the trading session on a particular day. It also analyzes the stock begins its daily trading activity. The third column is high column. The high column represents the maximum price the stock reached during the trading session. It gives insight into a stock highest valuation of the day. The fourth column, which is the low column. The low column represents the lowest price the stock traded at during the session. It is important for understanding the stock volatility and daily price range. The fifth column, which is a close column. The close column shows the stock price at the end of the trading session. It is a key metric for investor as it reflects the stock final value of the day. The final column, which is the adjacent column, which provides the closing price adjusted for factors like stock splits and our dividends. Let's take an example. On August 2004, a stock opened with a price of 2.5. The highest value it reached during the day was 2.6 and the lowest it got was 2.4. The datasheet shows that the stock closes with the mark value of 2.5. In our datasheet, we use the following Python library. First one is the Panda library, which we use for creating and manipulating the datasheet. The second one is NumPy library, which we use for statistical measure for both for group and ungrouped data. And the last library which we use is Matplotlib for the visual representation of data for group and ungrouped. By using Python, we found following statistical measures about our data sheet. First of all, we find the standard tendency metrics, which are mean, median, mode. Calculated mean, that is 19.83, represent the average opening price. Calculated median, which is 14.7, provide the middle value of offering a robust measures against outliers. Calculated mode, which is 14.8, indicate the most frequently occurring opening price. These matrices together help us understand the center of the data distribution. We also discuss dispersion matrix, which measure the spread of data. Range, the difference between the highest and lowest opening prices, showing the overall spread. Quartile deviation, reflect the spread of the middle 50% of data and help understand variability. Mean deviation, the average of absolute differences between each prices and the mean, offering another perspective on dispersion. And we also calculate the standard deviation. These matrices are crucial for assessing the variability in stock prices. We do this using Python. Finally, the code covers skewness, which measures the asymmetry of the data distribution. Carl-Person skewness. Quantify skewness using the mean, median, and standard deviation. Positive value indicate a right skew distribution, while negative value signify left skew. Bowley skewness is based on quartile and median, offering a robust measure against outlier. Understanding skewness helps us analyze whether the data is balanced or if it leans toward higher or lower values. We prove the positive skewness using frequency polygon. We can see that the tail of the data is on the right hand side, that is positively skewed. Then we find the same statistical measure for group data using the statistic formula of group data. So let us begin with the histogram of open prices. This graph shows the frequency distribution of stock opening prices in the datasheet. Each bar represents a range of prices and its height indicates the frequency of price within that range. From the graph, we observe that most open prices are concreted in the lower price ranges, with significantly fewer stocks opening at high prices. Moving on, the second graph is frequency polygon for group data. This line graph connects the middle point of each price range from the histogram and show the overall trend in price frequency. Peaks in the polygon highlight the most common price ranges, while dips indicate least frequent prices. Finally, we have a pie chart displaying the percentage contribution of stock opening prices for different days. Each significant represents a specific date and its size corresponds to the percentage of data associated with that day. From the chart, we observe that data is relatively evenly distributed across the dates.